With interest rates still higher than for many years, you may be among the homeowners wondering what happens when your fixed rate mortgage ends. I'm Bryn Lucas, and in this guide we're going to be exploring this topic and more. Before I get to that, remember, remortgaging can be complicated and depends so much on individual circumstances that it is really worthwhile talking to an expert. There's a link below that will connect you with our recommended mortgage advisors who'll be able to help you through the mortgage maze. Because there's a lot going on right now, let's start with a quick recap. Mortgages can be either fixed or variable. With a fixed rate mortgage, you're charged the same interest rate for a period of time. This means your mortgage repayments will be the same every month for however long the deal lasts, typically 2, 5 or 10 years. This is a big plus for those who prefer to know exactly how much their outgoings will be. A fixed rate also protects borrowers against interest rate rises of the kind we've seen recently. Even if the Bank of England base rate goes up, fixed rate mortgage payments stay the same. Historically, borrowers would pay more to fix their rate for longer, but it seems like the price cap is now closing. Most people fix their mortgage for 2, 3 or 5 years. 10-year fixes are a lot less common. Regardless of how long your mortgage rate is fixed for, what happens when the fixed period ends? Well, you'll usually automatically switch to your lender's standard variable rate, also known as the SVR. On a variable rate mortgage, the interest rate, and therefore the amount you repay each month, can change at any point. This could be higher or lower than fixed rate monthly payments. For example, in December 2020, the Bank of England base rate was an exceptionally low 0.1%, while a 2-year fixed rate mortgage was a smidge under 2.5%. Just 2 years later, the base rate hit 3%, while the average 2-year fixed rate mortgage was 6.5%. So for people coming off their fixed rates at the end of 2022 and moving to a variable rate, monthly repayments shot up. A £200,000 interest-only mortgage at an interest rate of 2.5% is £415 a month. The same mortgage at an interest rate of 5.7% would see your repayments more than double to £950 a month. One option when your fixed rate ends is to move to another fixed rate deal. With things still so fluid, it's worth exploring what's on offer with your mortgage broker, as you may be able to find a fixed deal that's cheaper than the standard variable rate. However, you'll usually have to move to a different lender, and that means paperwork and fees. Try to speak to a mortgage broker well before your fixed term ends, as most mortgage products can be reserved for up to 6 months. Well, I hope this quick guide has answered some of your questions. Stay with us for more essential home buying info. Subscribe and hit that alert button, and join me next time.